their global chief economist, Chetan Ahya, in an exclusive chat and started by asking him about the hypothesis which they are making about how the global growth rebound will actually become stronger going forward, led by Capex push in US, and then subsequently it will become broadened and emerging markets will also participate. That's what I asked him first.
So I think the biggest difference is the policy support that we are going to see in this cycle versus what we had seen, for example, post 2008. We think that both fiscal and monetary policy support, especially in DMs like the US, will be extremely expansionary even while we are well into the advanced stage of recovery. And that will ensure that aggregate demand is strong enough to lift corporate return expectations, and then the corporate sector will invest aggressively. As of now, we in fact have the evidence that the Capex has picked up in DMs and in EMs. In DMs, it's being driven by strength in consumption domestically, and in EMs, it's being driven by the fact that their external demand is strong. And as EMs are more trade-oriented, that's helping the EM companies to think about their return expectations changing and investing.
Right. Chetan, which other countries in developed markets, which do you think are taking those specific steps which will lead growth? We all know a bit about how US is embarking upon Build Back Better and other big countries, because those will be driving growth going forward, and also the role of EMs and which are those EMs which will be ahead in that.
So in DMs, it's kind of quite broad based. We are going to see recovery in US and in Europe both, but US is playing an outsized role in this cycle, and US is actually leading the front on the global cycle in terms of Capex. Within EMs, it's China, which is leading on investments. China's private investments have always been linked to improvement in external demand, and we're already seeing an evidence of that coming in through. But we should see it being broad-based across DMs and across EMs. Even some of the big economies in Asia, which will see improvement in external demand, they should see improvement in Capex.
Right. Chetan, how do you see the role of this dovish and a very accommodative stance from global central banks having an impact on inflation? Because, of course, that's one of the most important indicators reading to track about. And now rate hike talk is also kind of coming back on the table. How does all of that fit in your view?
So look, we've been highlighting that in this cycle, there is a regime shift taking place as far as the inflation dynamics is concerned. And it goes back to my earlier point that, look, the policy support has been expansionary even while we have seen an aggressive recovery already. For instance, in the US, we are expecting US GDP to reach pre-COVID path in third quarter of this year. And yet you would have seen the Fed, which would have not begun to hike interest rates. So it's a very different policy setup that is being taken up in DMs. And that is because they are trying to work through the challenges that they were facing even pre-pandemic, which is the issue of income inequality. Both the government and the Fed are trying to make recovery more inclusive and want to be sure that we have had all the low-income segment part of the population being on board in terms of jobs opportunity. And so because they are lagged, they are taking the risk of inflation coming back even more aggressively. So we are therefore expecting the inflation numbers to be higher in DM because of the way the policy support has been taken up. And we are also highlighting that, look, there is a risk that inflation overshoots the modest overshoot that the Fed is targeting. The Fed is indicating that it wants the inflation numbers to be between 2 to 2.5%. But because monetary policy is very lagged, we think that there is a risk that inflation can surprise on the upside, overshooting 2.5%. And in that scenario, you could have some challenges in global financial market. But that risk, we think, emerges in middle of 2022. In the interim phase, we think that the Fed will be able to manage the markets and the financial conditions.
Excellent. In fact, talking of red hot, there's a big commodity rally which is going on right now. Talking of crude, which is already back to pre-COVID levels. What are your thoughts on the way commodity, overall soft commodities, hard commodities are rallying right now and its own impact on inflation?
Yeah, so I mentioned about the Capex cycle. And when I think about commodities demand, the Capex cycle will have a big influence on that. And when we see the strength of Capex that we are forecasting, for global cycle, it will be the best in the last 5 cycles that we have seen. And as far as the US is concerned, it will be the best since 1940s. In fact, the US Capex cycle looks like it's similar to that we had seen post World War II. And guess what? We had a big fiscal expansion during World War II. And in this cycle as well, we've seen a big fiscal expansion. So that strength in aggregate demand is driving the Capex in the US. And that strength in Capex cycle tells me why you have this boom in the commodities market.
Fair point. Chetan, how are you reading the movements of the dollar? Because that does have an impact on flows, global flows, even emerging market flows.
So we think that in the near term, the dollar should be in a stable range. There are 2 countervailing forces that are in operation. One is whenever we see global reflation, you tend to see downward pressure on the dollar. And at the same time, we are looking for US interest rates to gradually go up ahead of other developed market countries. And so because of that rise in real interest rate differentials between US and other parts of the world, you have upward pressure, and both kind of counterbalance each other, and therefore we're expecting the dollar to be in a range bound.
Right. Chetan, my last question to you is on India in particular as a part of emerging market. Your call, of course, on India growth and the way we have navigated through the cycle has also been pretty bang on, I must say. And earnings and Capex cycle here too is looking upwards. What are your thoughts on India, the way central bank commentary has been coming in? Because historically we've seen whenever there's a big crisis in US, followed by expansionary policies of the Fed, emerging markets next 2, 3, 4 years also see ripple effect. Do you see that playing out here as well?
Yeah, we expect a turn in emerging markets, including India, going forward. Look, right now, if you think of it from investors' perspective, they have been still very skeptical on emerging markets. And the biggest factor that is holding back their interest in emerging markets is the challenges related to the COVID pressures and rise in cases in countries like India and Brazil. But we think that, to the extent to which emerging markets, while lagging, have finally started to take up vaccination, as you get towards the end of the year and early part of next year, we think emerging markets will also beginning to contribute to global growth meaningfully. And it's the same view that we have for India too. So we already have the support of external demand. There has been some improvement in Capex, which are of the companies which are focused on exports or related sectors. But then going forward, as you see recovery in consumption in a full-fledged manner with vaccination, you should see a more broad-based recovery from first quarter of next year in emerging markets, including India.
All right, with that, let's take a short break on that note. We'll come back and discuss markets and more stock-moving stories on the other side. Don't go anywhere.